Have you ever noticed this? Bitcoin moves 5% in a day, and suddenly it feels like the world is ending. Your phone lights up, charts turn red, your stomach tightens, and you hear the same sentence everywhere. Crypto is too volatile. But what if that's not true? What if crypto isn't volatile at all, and your time frame is? That's what this video is about. Because once you see it, you can't unsee it. And it completely changes how you experience crypto, how you invest, and how you sleep at night. Let's slow this down. Not the market, your perspective. Let me ask you something. If you zoom out on Bitcoin's chart to 15 years, does it look chaotic or does it look inevitable? That's the disconnect. Most people say they're long-term, but they feel short-term. They talk like investors, but react like traders. And that gap, that psychological gap, is where most people lose money. So let's break this down, step by step. No hype, no fear, just clarity. Point number 1. Volatility is not randomness, it's compression. Think about this. Bitcoin trades 24/7. No circuit breakers, no weekends, no central authority smoothing things out. Every emotion gets priced in immediately. Fear, hope, greed, panic, conviction. Stocks compress emotion into trading hours. Crypto doesn't. So what looks like chaos is actually transparency. The market is showing you everything in real time. When Bitcoin drops 8% overnight, that's not volatility. That's the market clearing leverage. That's weak conviction leaving the system. That's uncertainty being priced honestly. But here's the catch. If you're watching that move on a 5-minute chart, it feels violent. If you're watching it on a daily chart, it feels uncomfortable. On a weekly chart, it's noise. On a yearly chart, it barely exists. Same asset, same move, different emotional reaction. Why? Because time frames change meaning, and most people live inside the shortest one. Let me make this real. Imagine buying Bitcoin at $30,000. Price drops to $27,000. Twitter explodes. Bitcoin is dead. Macro is broken. This cycle is different. You feel stupid. You feel late. You feel wrong. Now zoom out. Bitcoin was $3,000 not long ago. Before that, $300. Before that, $30. Suddenly, that $3,000 drop doesn't feel like volatility. It feels like friction. The problem isn't the move, it's where your attention lives. Point number 2. Your brain was not built for exponential assets. This is huge. Human psychology evolved in linear environments. If you hunt today, you eat today. If you plant seeds, you wait months. Progress was slow, predictable. Bitcoin isn't. Crypto networks grow in jumps. Hash rate doesn't move smoothly. Adoption doesn't grow evenly. Liquidity arrives in waves. And price? Price reflects that uneven growth. Big flat periods, sudden spikes, violent pullbacks. Your brain hates this. It wants smooth progress. So when price stalls for months, you feel bored. When price spikes, you feel euphoric. When it drops, you feel betrayed. But nothing is broken. This is how emerging networks behave. Look at the internet. Years of nothing, then sudden explosions. Crypto is no different. But because price is visible and instant, it messes with your emotions. You don't experience the technology, you experience the chart. And charts don't care about your feelings. Here's the uncomfortable truth. Most people don't lose money in crypto because they're wrong. They lose money because they exit too early. They buy something revolutionary, then judge it by short-term price action. That's like judging the internet in 1996 based on modem speeds. Same mistake, different decade. Point number 3. Volatility is the cost of asymmetric upside. This part is rarely explained honestly. Everyone wants life-changing returns, but nobody wants the emotional price tag. Bitcoin didn't go from 0 to 6 figures smoothly. It went up 10x, down 80%, up again 20x, down 70%, up again. Every massive upside was paid for in volatility beforehand. There is no exception. If Bitcoin were stable, it wouldn't offer asymmetric returns. If Ethereum moved like a bond, it wouldn't be Ethereum. Volatility isn't a bug, it's the admission ticket. And here's the trap. People want volatility on the way up and stability on the way down. Markets don't work like that. You get both or you get neither. Think about early Amazon investors. Amazon dropped over 90% during the dot-com crash. 90%! Imagine holding through that. Most didn't, not because Amazon was bad, but because the time frame was wrong. They judged a generational company through a short-term emotional lens. Crypto is repeating this pattern on a compressed timeline. Point number 4. Most volatility is actually leverage unwinding. This matters more than people realize. Crypto markets are heavily leveraged. Perpetual futures, high leverage, low margin requirements. That means small price moves force liquidations. Liquidations create more selling creates more liquidations. It's a cascade. And it looks scary. Red candles, fast drops, panic everywhere. But zoom out. Nothing changed fundamentally. The network didn't break, blocks didn't stop, transactions didn't fail. Only leverage failed. And leverage always fails eventually. Volatility spikes when weak structures collapse. Then things stabilize. This is not chaos, this is cleanup. Here's the irony. The same people who complain about volatility trade in the most volatile environment possible. Short-term, high leverage, emotion-driven, then blame the asset. But if you remove leverage, extend your time frame, and align with the technology, most volatility disappears. Not from the chart, from your experience. Point number 5. You don't actually believe your own thesis. This is the hardest one. If you truly believed Bitcoin was digital scarcity, you wouldn't panic over short-term price moves. If you truly believed Ethereum was global settlement infrastructure, you wouldn't obsess over weekly candles. If you truly believed crypto was reshaping finance, you wouldn't react to noise. Volatility exposes conviction gaps. It reveals where belief ends and hope begins. Most people say they're long-term until the market tests them. Then they realize they weren't. And that's okay. Awareness is the first upgrade. Let's talk about time, because time is the real asset. Bitcoin rewards patience. Not intelligence, not prediction, patience. The blockchain doesn't care about your entry. It doesn't care about your emotions. It produces blocks every 10 minutes, relentlessly. That's the signal. Everything else is noise. Here's a simple mental shift. Instead of asking, why is Bitcoin so volatile, ask, why am I measuring a long-term asset with a short-term ruler? That question changes everything, because suddenly nothing feels broken. Let me make this real. 3 time frames. Trader time frame, days to weeks. Pure price action, pure emotion. Investor time frame is years, cycles, adoption, scarcity. Network time frame is decades. Infrastructure, monetary evolution, geopolitics. Most stress comes from mixing them. You invest on a network thesis, then monitor it like a trader. That's psychological torture. Pick one and align your behavior with it. Look at Bitcoin adoption, sovereign interest, ETF infrastructure, custody improvements, energy integration. None of this shows up on a 1-hour chart, but it shows up over time. That's where conviction lives. Crypto doesn't punish impatience randomly. It transfers value from impatient participants to patient ones. That's it. That's the game. Always has been. Now, let's zoom back out. Bitcoin's volatility is declining over time. This is important. Early Bitcoin moved 50% in days. Now, that's rare. As market cap grows, as liquidity deepens, volatility compresses. But perception lags reality. People still talk like it's 2013. The asset matured, the mindset didn't. Here's something most people miss. Stable assets don't make you rich. They preserve wealth. Volatile assets create wealth. Crypto is still in that creation phase. Expecting stability now is like expecting calm seas during the age of exploration. Wrong era. So what's the real lesson here? Crypto isn't volatile. Your expectations are. Your time frame is. Your emotional exposure is. Fix those and suddenly crypto makes sense. Not calmer, clearer. Let me speak directly to you. If price movements stress you out, you're either too leveraged, too exposed, or too short-term. Not wrong, just misaligned. And misalignment feels like volatility. Here's the quiet truth. The people who survive crypto don't outsmart the market. They outweight it. They understand cycles, they respect time, and they detach emotion from noise. They don't react, they position. So next time Bitcoin drops, pause, zoom out, and ask yourself, did the network break or did my time frame just get exposed? That question alone